Welcome back everyone. Today I've got for you the top 4 growth stocks to buy in 2026. They are growing anywhere from 25 to 100% per year, and still most investors have no clue they exist. Looking at the existing portfolio performance of the stock tips on this channel, we see that we are outperforming the MSCI World by quite a bit, and more to come here. These are exactly the types of stocks that will become true multibaggers in the future. These are stocks that could 5x, 10x or even 100x in stock price over the long term. For each stock, I'm going to give you a short overview rated based on my 10-step process and give you an overall score for the stock. By the end of the video, you'll understand how to look for multibaggers and have an interesting stock ideas list to invest in 2026. One of these stocks scores exceptionally high, so make sure you stay until the end of the video. Also, at the end, I've got a hidden bonus stock in store for you that scored extremely high on my scorecard. So let's start with Paysign. Paysign is a payments technology company that specializes in prepaid card programs and payment processing. Its core customers are healthcare providers, pharmaceutical assistance programs, and plasma donation centers. Paysign essentially runs the entire payment infrastructure for these clients, including compliance, reporting, and settlement. They had quite a run in 2025 and more room to go from here. Paysign is listed in the Nasdaq and has a market cap of around $290 million. Growth at Paysign is steady but not explosive. Revenues and earnings are growing in the mid-teens, which is solid but clearly slower than some of the other companies in this video. The moat is decent, switching costs are meaningful, but competition in payments is still intense. The runway remains attractive as healthcare payments become more complex and regulated, but expansion options are somewhat limited. They are still very much in the niche without expanding to other verticals. Returns on capital are respectable, though not exceptional, with returns on equity coming in at 20% and returns on invested capital at 18%. The company is still run by its founder, with C-level executives holding 17% of the stock. This is great as it aligns interests with shareholders. They pay no dividends and focus on the long-term growth, which is a great use of capital. The balance sheet is strong with very low debt, but they do not have much cash on hand. They increase share count by 1.5% per year, which is okay for long-term shareholders and mostly due to share-based compensation for management. Valuation is reasonable, but the PEG sits at an expensive 2.84. The market cap is still small at around $290 million and allows for upside if growth accelerates. Overall, Paysign earns a multibagger score of around 3.84 out of 5. This is a solid, lower risk compounder but lacks the explosive upside of the top names. So let's get into the juicy ones. Next up is Zoomed Technologies. Zoomed is a digital marketing and SaaS platform that helps big online businesses acquire users for a set maximum cost per acquisition. Its core clients include e-commerce platforms, mobile app developers, and media companies, but they have higher revenue exposure to their top clients such as Amazon and Shein. Zoomed had an amazing run over the last years because in 2023 they hired a new CEO that cut costs dramatically while increasing revenues. This led Zoomed to become profitable. Also, the losses from businesses they acquired were written off by 2024, which boosted net income. They are listed in Canada and Germany and have a market cap of around $90 million. Revenue growth is about 20% but could be higher in 2026 due to their higher exposure to sports betting clients who will experience a great 2026 due to the World Cup and the Winter Olympics. EPS, however, will be temporarily lower because they no longer benefit from tax breaks in 2026. The moat is moderate, meaning the company offers an all-in-one acquisition platform, but the competitive landscape in digital marketing is intensive. The runway looks strong with expansion potential across geographies and adjacent verticals. They focus more on profitable industries now, such as betting, driving improved margins. Returns on capital are excellent, with returns on assets at 57%, returns on equity at 83%, and ROIC at 78%, really demonstrating high efficiency in capital use. The founders are still involved with high insider ownership, and the new CEO has proven himself. They don't pay dividends. The only risk here is them doing bad mergers and acquisitions as they did in the past. The balance sheet is very healthy with minimal debt and lots of cash on hand. Dilution has been minimal at 1.3% annually. Valuation-wise, Zoomed is very attractive with a PE ratio of just 5 and a price-to-sales ratio of just 1.26. With a market cap of $90 million, Zoomed Technology still has significant upside potential if growth accelerates and the stock is being discovered by the market. Overall, Zoomed earns a multibagger score of 4.19 out of 5. Being above our 4 is a no-brainer threshold. Now, let's move to Sezzle. Sezzle is a buy now pay later platform that allows consumers to split purchases into interest-free installments. What makes Sezzle different is its strong focus on responsible spending, transparency, and credit building tools, meaning they help consumers get better credit scores. The company partners with thousands of merchants and primarily targets younger consumers who want flexibility without falling into debt traps. The stock had a big run-up in mid of 2025 before crashing down in the last month due to less than expected growth. Sezzle is listed in the US, Germany, and Italy and has a market cap of about $2.2 billion. Sezzle's growth came down from being very strong to just pretty strong, with revenue and earnings expected to grow at about 28% per year over the next 3 years. Profitability has improved significantly and free cash flow has turned positive. However, the real subscriber growth slowed down to just 11% year over year, which is a huge issue here. This means they need to monetize existing users more if they are to keep up with previous growth rates. The small moat comes from merchant relationships, the trust users put into the brand, and from disciplined risk management. The runway is long. The BNLP market grows with 13% per year and has a low penetration of the total online payment market. Return metrics are exceptional, with ROIC being 54%, for example. The company is still founder-led and has a very high insider ownership, mainly from the founder, of 47%. They use their capital well and have a healthy balance sheet, especially for a fintech company. There's no increase of share count. Valuation-wise, Sezzle looks rather cheap, with the PEG ratio sitting at 0.88 and the Rule of 40 being at 59%. With a market cap entering mid-cap territory soon, Sezzle scores a multibagger score of 4.27 out of 5. This is really a great setup, so feel free to dig deeper and do your own research into this stock. Next up is Shelly Group, which really scored the highest on the list here. Shelly is a company that keeps on winning. The chart just speaks for itself. You see, the company is going up, then goes sideways for half a year, and then goes up another 40% or so. Shelly Group is a European Internet of Things company focused on smart home devices. They design and sell smart switches, plugs, sensors, and energy management products that allow users to automate and control their own homes. They are listed in Bulgaria and Germany and have a market cap of around $1.3 billion. Over the last 5 years, Shelly has grown revenues roughly fivefold, and the global smart home market continues to expand rapidly. They do have a moat in that users really love Shelly products, engage in online communities to help each other set up devices, and the products being affordable. And they are best integrated with all kinds of other smart home devices. The runway is excellent. Shelly can expand geographically and move into areas like energy management, smart security, and they can even sell more to professional installers. Returns on capital are very strong, especially for a hardware-enabled business. The return metrics are at about 30% each. The company is still led by the two founders and another co-CEO, with the founders holding over 65% of shares. They do disciplined M&A and pay a very small dividend. Balance sheet and dilution look very healthy, and the multiples are fair, given the high growth that Shelly has. Also, the market cap still allows for some upside. Shelly Group earns a multibagger score of 4.51 out of 5, which is really the highest score I've seen so far. This is a high-quality, long-term compounder with no end in sight. But before we finish, I want to show you one bonus stock that nobody really talks about. This bonus stock is Spyrosoft. Spyrosoft is a Polish IT and digital engineering company. They build custom software for industry like automotive, healthcare, and fintech. They employ nearly 2,000 engineers across Europe, the UK, and India. One good thing is that the stock price has not run too far yet, even though growth rates are impressive. They are listed in Poland and Germany and are considering a listing in the US. The market cap is around $180 million. Spyrosoft guides for 25% yearly EPS growth and might beat these targets even. The digital engineering market grows at 20% and they have room to expand into new geographies. Return metrics are strong, with returns on equity coming in at 39%, for example. What truly sets Spyrosoft apart is ownership. The founders are still the management team and they hold more than 80% of the shares, which creates exceptional alignment with shareholders. They look for targeted acquisitions and pay no dividends, which is good. The balance sheet is very healthy and they do not dilute. Despite all of this, the valuation remains surprisingly attractive because this is an undiscovered microcap. PE is at 16 and the price to sales ratio is at 1.1. Spyrosoft scores an amazing 4.41 out of 5 on my Multibagger Scorecard. This is one of the highest quality microcap compounders most investors have never heard about. So let's sum everything up. We have Paysign, which offers stability, Zoomed, which is a high-risk, high-reward play, Sezzle, which combines growth and discipline, Shelly Group, which is a high quality compounder, and there is the bonus Spyrosoft, which is a reliable hidden gem. As always, this is not financial advice, but please do your own research. This is just to give you some great ideas to look further into. If you want more in-depth multi-bagger analysis, consider subscribing and check out my other videos. Thank you so much for watching and see you in the next video.